December 24th, 2025. 3 days. That's how long it took for China's only pure play silver fund to go from unstoppable rocket ship to emergency shutdown. 3 consecutive days hitting the 10% upper circuit limit, then one brutal trading session, erasing it all with a 10% plunge to the lower limit. The UBS SDIC Silver Futures Fund, the vehicle that let ordinary Chinese citizens ride silver's extraordinary 169% surge in 2025, just got the emergency brake. Hard. And the fund manager didn't just tap the brakes. They called the gains unsustainable and slammed the door shut on new investors entirely. But here's what should grab your attention. This isn't some obscure Chinese financial drama happening in a vacuum. This is a warning signal about what's really happening in the global silver market. Because when the world's largest consumer of industrial silver starts panicking about speculative frenzies, when premiums explode to over 60% above underlying asset values, when social media tutorials on arbitrage trading go viral enough to force regulatory intervention, you're not watching normal market behavior. You're watching the collision between genuine physical scarcity and speculative fever. So let me show you what actually happened this week in China, why it matters far more than the financial headlines suggest, what it reveals about silver's supply situation, and why this might be telling us something important about where silver is headed in 2026. Not predictions, observations. Because when authorities have to shut down the only silver investment vehicle in the world's second largest economy, that's data worth paying attention to. Let's start with what actually happened, because the timeline reveals exactly how fast this situation deteriorated. On December 23rd, 2025, silver hit a record high around $72 per ounce. By December 26th, it had pushed even higher to approximately $78. This is silver's best annual performance since 1979, up roughly 169% year to date according to multiple market sources. Not 16%, not 50%, 169%. Think about that for a moment. Gold, which everyone talks about, is up around 73% this year. That's spectacular, but silver more than doubled gold's performance. And if you're wondering why you haven't heard more about this, well, you're about to understand exactly why. The UBS SDIC Silver Futures Fund, China's only pure silver investment vehicle available to retail investors, had been climbing relentlessly. For 3 straight trading days last week, the fund hit its maximum daily gain of 10%. 3 days. Limit up, limit up, limit up. That's not normal market function. That's a stampede. The fund is premium the gap between what the fund was trading at versus the value of its underlying silver futures. Contracts on the Shanghai Futures Exchange exploded from 7% at the start of December to over 60% by December 24th. Let me make sure that's clear. Investors were paying 60% more than the actual silver futures were worth just to get exposure through this fund. Why would anyone do that? Because it's the only pure silver game in town for Chinese retail investors. If you're a regular person in China who wants direct silver exposure without jumping through regulatory hoops, buying physical metal, or navigating complex international investment channels, this fund is it. And when silver started going vertical throughout 2025, everyone wanted in. Then the hammer came down. After hitting the 10% upward limit for 3 consecutive sessions, UBS SDIC Fund Management announced restrictions on December 25th. Subscriptions for Class C shares, the preferred vehicle for short-term traders, would be capped at just 100 yuan, about $14, down from the previous limit of 500 yuan, an 80% reduction in how much new money could flow in. The fund dropped 10% that day, maximum daily loss. But the premiums still hovered around 44%. Even after crashing, investors were still paying 44% over net asset value. That should tell you something right there. The demand hadn't disappeared. It had just been blocked. When that first restriction didn't cool things down sufficiently, the fund manager went nuclear. On Friday, December 27th, they announced a complete halt on new Class C share subscriptions starting Monday. The doors closed. If you're not already in, you're not getting in. Class A shares, typically for longer-term holders, got their subscription limit slashed to 100 yuan as well. The official language used should grab your attention. The fund manager explicitly called the rally unsustainable. Not volatile, not speculative, unsustainable. That's financial speak for, this is going to blow up, and we refuse to be responsible when it does. Now, here's where most Western coverage completely misses the point. The narrative you'll read frames this as China cracking down on speculation. Regulators protecting retail investors from themselves, authorities cooling an overheated market. And sure, that's part of the story, but that narrative completely ignores what's actually driving the underlying dynamics. The premium didn't spike to 60% because Chinese investors suddenly lost their minds. It spiked because physical silver in China is genuinely tight. And when I say tight, I mean structurally constrained in ways that matter for global markets. On December 24th, The Shanghai Gold Exchange showed physical silver trading at $78.55 per ounce. That's over $6 above the COMEX benchmark that day. According to market data, premiums in Shanghai hit $8 per ounce at some points. That's not speculation creating that spread. That's physical scarcity in the world's largest consuming market. Wait, let me back up here because this is important. China isn't just a big silver consumer. China is the silver consumer. Solar panel manufacturing, which China dominates with nearly 90% of global production capacity, consumes approximately 200 million ounces of silver annually worldwide. Electronics manufacturing, another Chinese specialty, uses around 445 million ounces per year globally, with China accounting for over 70% of electronics production. And here's the structural problem that creates the foundation for all of this. Silver supply isn't keeping pace. Global mine production has been essentially flat to declining since 2016, down about 7%, despite prices more than doubling. Why? Because silver is primarily a byproduct metal. Roughly 70% of silver comes from mines digging for copper, lead, and zinc. When those base metal markets are weak or stable, silver production doesn't increase no matter how high silver prices go. Meanwhile, industrial demand keeps accelerating. China's National Energy Administration plans to add 160 gigawatts of solar capacity in 2025 alone. Every gigawatt requires approximately 10 tons of silver. That's 1,600 tons just from Chinese solar expansion this year. And silver paste used in solar panels is typically 90% silver content. You can't substitute it without significant efficiency losses. So here's the real picture. China needs massive amounts of physical silver for manufacturing. China's citizens want silver as an investment hedge, but China doesn't produce enough silver domestically to meet both demands. They import it. Except global supply is tightening everywhere. London silver stockpiles, the traditional global buffer, are reportedly valued at under $50 billion compared to gold's $1.2 trillion. There are no central bank silver reserves to tap like there are with gold. Industrial users, solar manufacturers, electronics companies, they're all competing for the same constrained supply. And now retail investors are piling in too, not just in China, but globally. This is the context for understanding why that premium hit 60%. It wasn't purely irrational speculation. It was Chinese investors recognizing that getting silver exposure, any silver exposure, was valuable enough to pay extraordinary premiums. Because the alternative, trying to buy physical silver in Shanghai at those elevated local prices or navigating international investment channels, wasn't necessarily better. Now let me show you the social media angle, because this is where the story gets genuinely fascinating. The fund's explosion wasn't driven by institutional money or hedge funds. It was driven by Chinese retail investors coordinating on Xiaohongshu, the social commerce platform known in English as Little Red Book or Red Note. Xiaohongshu is China's answer to Instagram blended with Pinterest and shopping features. Over 300 million monthly active users, primarily young, urban, educated Chinese women. It's where people share lifestyle content, product recommendations, travel experiences. And in late December, it became ground zero for silver trading tutorials. Step-by-step guides showing retail traders how to exploit price gaps between the fund's exchange-traded units and its over-the-counter shares. How to flip between Class C shares for quick gains. How to maximize exposure using the fund's structure. These weren't sophisticated hedge fund strategies. These were literal how-to posts with screenshots, arrows, and simple explanations that anyone with a smartphone could follow, and they went viral. Millions of views, thousands of shares, entire communities dedicated to silver trading strategies. This is the democratization of financial speculation, Chinese style, and it absolutely terrified the fund managers. Because when millions of retail investors armed with social media tutorials and mobile trading apps all decide to pile into the same limited product simultaneously, you don't get orderly price discovery. You get a stampede, and stampedes end badly. The fund manager's explicit warning about behaviors such as arbitrage tutorials on social media platforms fueling speculative hype was not corporate boilerplate. It was genuine alarm. They were watching their fund turn into a social media phenomenon in real time, with the premium disconnecting entirely from any rational fundamental basis. And here's what matters. The Chinese government's response, shutting down new subscriptions, wasn't really about punishing speculators. It was about preventing a blow-up that could damage confidence in financial markets more broadly. Because if this fund had been allowed to continue, if that premium had hit 80%, 100%, and then silver prices simply pulled back even 10%, the losses would have been catastrophic for hundreds of thousands of retail investors who paid massive premiums. China learned from previous bubbles. They watched the 2015 stock market crash. They saw cryptocurrency mania and subsequent crackdowns. They understand that when retail speculation detaches from reality, it ends badly. So they pulled the plug before it got worse. But pulling the plug on the fund doesn't solve the underlying issue. Chinese citizens still want silver exposure. Chinese manufacturers still need physical silver, and global supply still can't meet combined investment and industrial demand at current prices. So what happens next? Well, the premium is still elevated. Reports indicate it dropped to around 44% after the restrictions, but that's still massively above the 7% level from early December. Even after the crash, even after subscriptions got shut down, investors are still paying 44% over net asset value for whatever limited shares they can access. That tells you the demand hasn't evaporated. It's just been blocked from this particular channel, and that money doesn't disappear. It flows elsewhere. Some will chase other precious metals products. Some will try to buy physical silver despite higher premiums and potential delivery challenges. Some will look at gold, and some will find creative ways around capital controls to access international silver markets. Meanwhile, silver's fundamental drivers haven't changed. Industrial demand continues growing. Solar installations globally are projected to increase significantly through 2030. Electric vehicle production, which uses significantly more silver per vehicle than traditional cars, keeps accelerating. Data centers supporting AI expansion require silver-intensive electronics. Every major technology trend points toward more industrial consumption, not less. And supply? Multiple research organizations project that global supply may struggle to meet even 65% to 70% of demand by 2030 without significantly higher prices or technological substitution breakthroughs. That's not a tight market. That's a structural deficit that can only be resolved through higher prices, incentivizing new supply, demand destruction through substitution, or both. This is why the Chinese fund crisis matters for everyone, not just Chinese investors. It's not about one speculative bubble. It's about what happens when the world's manufacturing powerhouse, the country that produces most of the electronics, solar panels, and industrial goods that consume silver, can't even satisfy its own citizens' demand for silver investment products without creating dangerous market distortions. If China, with its massive refining capacity, its proximity to Asian supply chains, its state control over resource allocation, if China is seeing premiums spike this dramatically in physical market tightness, what does that tell you about global market conditions? Now, let me address the obvious question. Is silver's rally sustainable? The fund manager used that exact word, unsustainable, after all. And it's important to be precise about what that means. What they're actually saying is that a 60% premium over net asset value is unsustainable. That social media-driven speculation creating such massive disconnects from underlying futures values is unsustainable. That's different from saying silver's price rise itself is unsustainable, because silver at $75 to $78 isn't disconnected from observable market fundamentals. In 1980, silver hit $49. Adjusted for inflation using standard calculations, that's approximately $180 to $185 in today's money. We're not even halfway to the inflation-adjusted all-time high. And the structural story for silver, growing industrial demand meeting constrained supply, isn't speculation. That's observable, documented reality. Multiple industry research organizations point to sustained supply deficits. The Silver Institute, which is the industry's own research body, not some promotional newsletter, projects tightness continuing through the decade. Independent commodity analysts reach similar conclusions based on different methodologies. What is genuinely unsustainable is expecting financial products to maintain 60% premiums indefinitely. That's not how markets work long term. Premiums like that exist temporarily when supply channels are blocked or demand is artificially concentrated in one vehicle. But they correct, often violently, when reality reasserts itself or alternatives emerge. That's what happened in China. The correction wasn't about silver's fundamentals. It was about one specific fund becoming disconnected from rational pricing through social media amplified speculation. And Chinese authorities, understanding how that scenario typically ends, decided to stop it before the finale. Here's what you should understand from this situation. First, physical silver markets show signs of genuine tightness. When Shanghai is trading $6 to $8 above COMEX, that spread reflects physical supply challenges in the world's largest consuming market, not just short-term volatility. Second, investment demand for silver is global and appears to be growing. It's not just China. Western silver ETFs have seen significant interest. The broader precious metals complex is attracting flows as concerns about currency stability, inflation, and geopolitical risks persist. Third, industrial demand is structurally rising and faces significant substitution challenges. Current solar panel and electronics technologies depend heavily on silver's unique properties. Meaningful substitution requires years of research and development, not quick engineering fixes. Fourth, supply isn't responding quickly enough to price signals. New mines take 5 to 10 years to develop. Recycling faces economic and technical constraints. And most importantly, silver is largely a byproduct, so its supply depends on completely different metals markets. Put those factors together, and you get conditions that suggest higher prices over time. Not in a straight line, obviously. We just watched one of China's major silver investment vehicles crash 10% in a single day after hitting 3 consecutive limit-up sessions. Volatility is inherent to silver markets, but the trajectory suggested by observable fundamentals points upward over longer time horizons. And what China just demonstrated is that even with government intervention, even with capital controls, even with subscription limits and circuit breakers and all the regulatory tools authorities have to manage markets, they cannot manufacture more physical silver. They can slow speculation. They can control money flows into specific investment products. But they cannot change the underlying supply-demand equation. So where does this leave us heading into 2026? Silver just completed its best year since 1979, up over 165% by most measures. The Chinese fund crisis created brief panic and significant volatility, but nothing about the fundamental story changed. If anything, it received confirmation. Because when the world's largest industrial consumer of silver struggles to satisfy domestic investment demand, when premiums spike to 60% just to access investment products, and when authorities have to shut down subscription channels to prevent worse outcomes, that's not bearish for silver. That's validation that physical supply constraints are real and binding. And here's something most analysis misses. This happened at $75 to $78 per ounce. Imagine what happens if silver continues toward $80, $90, or $100. The pressure on Chinese manufacturers, solar companies, electronics firms intensifies. Some will attempt to substitute silver away, but that takes years to implement at scale. Meanwhile, higher prices typically attract more investment attention globally, not less. More retail investors notice silver setting records. More wealth managers consider adding exposure. More institutions potentially hedge currency risks with precious metals. The feedback loop can work in both directions. China's intervention this week was clearly a warning shot, a message to speculators that disconnected premiums won't be tolerated. But it's also, unintentionally perhaps, an admission that they're concerned about silver market dynamics, concerned enough to take dramatic, unusual action. And when governments worry enough about commodities to intervene, it often reveals that underlying conditions are more stressed than public statements acknowledge. So pay attention to what just happened in China. Not because it predicts next week or next month with certainty. Short-term price action remains volatile and unpredictable. Pay attention because it reveals underlying market structure. And that structure, physical supply constraints, blocked investment access, industrial demand that cannot easily decline, suggests this story has further chapters yet to be written. The Chinese fund might be closed to new investors, but the global silver market isn't. And if you understand what that 60% premium was really signaling about scarcity and demand, then you understand why this might be just the beginning of a longer, more complex story. 3 days of limit-up moves, one 60% premium, one dramatic shutdown, and one very important question. If China couldn't handle retail demand for silver exposure at these prices, what happens when prices go significantly higher? That's the question markets will be asking in 2026.